90% of traders lose money, not because they lack intelligence, not because they can't read charts. They lose because they fall into the same 12 psychological traps that have destroyed speculators for over a century. Jesse Livermore, the man who made over $100 million trading in his lifetime, identified every single one of these traps, most of them by losing fortunes himself. Today you'll learn the exact psychological errors that separate the 10% who win from the 90% who lose. Drop a comment right now. What's your biggest trading challenge? It's 1929. Jesse Livermore stands at the peak of Wall Street. He's just made $100 million shorting the market crash, the equivalent of over $1 billion today. But here's what most people don't know. This same man had been completely broke 3 times before. Wiped out. Starting over from nothing. What changed? How did the same person go from bankruptcy to becoming the most successful speculator of his era? He stopped fighting his greatest enemy, himself. Most traders think the battle is against the market. They study charts for hours. They search for the perfect indicator. They hunt for inside information. But they're fighting the wrong war. The real battle happens in the 6 inches between your ears. It's like a soldier obsessing over his rifle's specifications while ignoring the landmines under his feet. No amount of technical knowledge saves you when you step on a psychological landmine. Livermore discovered something profound. The game of speculation is the most uniformly fascinating game in the world. But it is not a game for the stupid, the mentally lazy, the man of inferior emotional balance, nor for the get-rich-quick adventurer. They will die poor. He documented 12 specific psychological traps, 12 recurring patterns of self-destruction he witnessed in thousands of traders and experienced himself. These aren't theoretical concepts. Each trap cost him real money before he learned to avoid it. And in 1940, 1 year before his death, he wrote them down as warnings for future generations. Let's examine each trap and how to disarm it. Trap 1. Averaging down on losing positions. Averaging. Down means buying more of a losing position to lower your average entry price. You buy at $50. The stock drops to $47. So you buy more, thinking you're getting a bargain. Now your average is $48.50. Sounds logical. It's actually a landmine. You're doubling down on being wrong. Think of it like a general sending reinforcements to a battle he's already losing, instead of retreating to fight another day. Here's where most traders destroy themselves. You buy 100 shares at $50. 3 days later, it's at $47. You're down $300. That bothers you, so you buy another 100 shares at $47. Now I only need it to get back to $48.50 to break even. You think, perfectly logical. But here's what you didn't consider. If the stock drops to $44, you now have a $600 loss on the first shares and a $300 loss on the second. $900 total. You turned a manageable loss into a catastrophe. Livermore stated it directly. Never average losses. Let that thought be written indelibly upon your mind. The professional does something radically different. He never adds to a losing position, ever. Instead, he only adds when he's already profitable. Livermore developed a strict rule. If your first commitment shows you a loss, you're wrong about the market's direction. Accept it. Close the position. Preserve your capital for when you're actually right. Think about it. If you buy at 50 and it immediately drops to 47, the market just told you something. It said wrong. The amateur argues with that message. The professional listens and acts. He knows that protecting capital is how you stay in the game long enough to catch the big moves. Let me show you this in action. Livermore once bought 20,000 bales of cotton because he was convinced it would rally. The market ran up 15 points on his order and collapsed back to where it started within 24 hours. He took a $30,000 loss and got out. But he couldn't shake his conviction that cotton would rise. So he bought another 20,000 bales. Same thing happened. Another $30,000 loss. He repeated this 5 times in 6 weeks. Each time he entered the position, watched it fail, and had the discipline to exit rather than average down. Total cost, $200,000. But here's the crucial point. Those losses were controlled. Had he averaged down on the first position, adding at each decline, he could have lost everything when cotton finally crashed. Instead, he lost his test capital but preserved his core account. But knowing when to exit a bad trade means nothing if you never let your good trades develop. Because the second trap is even more insidious, it kills profitable trades before they can become truly profitable. Trap 2. Taking profits too quickly while holding losses too long. This trap operates on backwards psychology. You buy at $30. Next day it hits $32. You're up $200. Fear grips you. What if I lose this profit tomorrow? So you sell. But when you're down $200, that same fear disappears. It'll come back, you tell yourself. You hold. This is inverted thinking. You're fearful when you should be hopeful, and hopeful when you should be fearful. It's psychological warfare you're waging against yourself. Most traders create their own misery through this pattern. You buy a stock at 30. It jumps to 32 in one day. Suddenly you're nervous. You think, if I don't take this 2-point profit now, I might lose it tomorrow. Out you go. Meanwhile, the stock rallies to 40 over the next 2 weeks. You missed 38 points of profit because you feared losing 2. Conversely, you buy another stock at 30. It drops to 28. You're not worried. It's just temporary, you rationalize. It'll recover. You hold it down to 25, then 22. A 2-point loss becomes an 8-point disaster. Livermore observed this pattern destroy more traders than any other. The professional thinks opposite to the amateur. Livermore's rule was simple. Profits always take care of themselves, but losses never do. When he had a 2-point profit, he asked himself, why should I worry about losing 2 points I didn't have yesterday? If I can make 2 points in one day, I might make 5 next week. He stayed in winning trades as long as the market acted right. But losses? Different story. When a position showed a 2-point loss, he became genuinely worried. That small loss could become 10 points, then 20. He cut it immediately. The professional knows you can't make large profits without allowing them room to grow, and you can't survive if you let small losses become large ones. In 1924, Livermore bought 5 million bushels of wheat at a pivotal price point. Within days, he had a 25-cent per bushel profit. That's $1,250,000 in paper profits. Most men would have cashed out immediately. Massive profit. Pat yourself on back, go home. But Livermore recognized his error. I realized I had made a great mistake. I was altogether too anxious to convert paper profits into actual cash. He had the courage to re-enter at 25 cents higher than where he'd sold. Why? Because the trend was still intact. The market hadn't given him the danger signal. That decision, staying in the winning trade instead of grabbing quick profits, eventually turned into over $3 million when he finally exited at the proper signal. 25-cent profit became a $3 profit through patience. But staying patient with winning trades requires something most traders never develop: the discipline to do nothing most of the time. Which brings us to trap 3, the trap that keeps traders perpetually on the wrong side of major moves. Trap 3. Overtrading and needing constant action. Overtrading is the urge to always be in the market. You close one trade and immediately hunt for the next. It feels productive. You're actively working. But it's like a sniper firing his rifle constantly instead of waiting for the perfect shot. Livermore put it bluntly. There are only a few times a year, possibly 4 or 5, when you should allow yourself to make any commitment at all. In the interims, you are letting the market shape itself for the next big movement. The amateur cannot sit still. If he's not in a trade, he feels he's missing out. Every day he watches the ticker, the market's moving, he needs to be part of it. It's like a poker player who must play every hand. He buys on Monday, sells Wednesday, buys again Friday. Each trade feels justified in the moment. But here's the mathematics. If you make 20 trades per month with average commissions and slippage, you need to be right 55 to 60% just to break even. And most of those trades, they're happening at random times, not at the strategic moments when real moves begin. You're burning capital on noise while missing the symphony. The professional views speculation differently. He's not trying to catch every wiggle. He's waiting, patiently, sometimes for weeks, for the market to reach what Livermore called the pivotal point. That moment when conditions align and a major move is about to begin. Think of it like military reconnaissance. Small troop movements mean nothing. But when you see battalions advancing, something significant is happening. The professional waits for battalions. He studies his records. He watches. And when that pivotal moment arrives, he acts decisively with size. Then he sits back and lets the market do the work. Livermore once told a story about a successful speculator who lived in the California mountains and received stock quotes 3 days old. 2 or 3 times per year, this man would come down from the mountains, walk into his broker's office, and place enormous orders. He consistently made money. When asked how he could possibly trade successfully with 3-day-old information, the man replied, "I make speculation a business. I would be a failure if I were in the confusion of things and let myself be distracted by minor changes. I like to be away where I can think. Real movements do not end the day they start. It takes time to complete a genuine movement." This man understood what the constantly trading crowd did not. The big money is made by identifying major moves and riding them, not by trying to scalp every minor fluctuation. Livermore adopted this philosophy. In between his major campaigns, he did nothing. Absolutely nothing. Of course, waiting for the right moment requires you to actually recognize it when it arrives. But Trap 4 causes most traders to jump in too early before the market is ready. Trap 4. Acting on opinions instead of market confirmation. This trap is subtle. You analyze a stock. Everything looks perfect. Strong fundamentals. Good chart pattern. You're convinced it's going up, so you buy immediately. That's the trap. You're trading your opinion, not the market's reality. Livermore's core principle: markets are never wrong. Opinions often are. You must wait for the market itself to confirm your opinion through price action. It's like a general who plans a brilliant strategy but waits for reconnaissance to confirm enemy positions before committing his troops. Strategy without confirmation is recklessness. Here's how this trap springs. You believe stock XYZ should rally from $25 to $50. Your analysis is solid, so you buy at $25. The stock drifts between $22 and $28 for 3 months. You get bored. You sell at $26. 2 weeks later, it breaks out to $30 and runs to $50, exactly as you predicted. You were right about the destination, but wrong about the timing. Or worse. You buy at $25, it drops to $22, you lose patience, sell, and only then does it rally. Livermore experienced this repeatedly before he learned, after forming a definite opinion with respect to a certain stock, do not be too anxious to get into it. Wait and watch the action of that stock. The professional develops an opinion. Let's say stock XYZ should go from 25 to 50. But he doesn't act yet. He waits. He watches the stock trade. He determines a pivotal point, perhaps $30. His rule: I will only buy after the stock breaks through 30 and proves strength. When the stock finally reaches 32, he buys. Why? Because the market just confirmed his analysis. That stock had to get strong enough to break through resistance. By waiting for confirmation, he enters with the wind at his back. He might miss the move from 25 to 30, but he catches 30 to 50 with confidence. And more importantly, if the stock never breaks 30, he never risks capital on a failed idea. In 1915, Livermore was convinced Bethlehem Steel would break through $100 per share and move significantly higher. The stock was trading at 87 3/8. Most traders would have bought immediately at that cheap price. Not Livermore. He waited 3 weeks, watching the stock's action. On April 8th, Bethlehem Steel broke through 100. That's when Livermore pounced. He accumulated his entire position from 99 to 99 3/8. The same day, the stock exploded to 117. Within 5 days, it reached 155, a breathtaking move of over 50 points. By waiting for the market to confirm his opinion through the pivotal point breakthrough, Livermore entered at exactly the right moment. The stock never looked back. His patience turned conviction into massive profits. Waiting for confirmation is crucial. But even when you're right and in the trade, Trap 5 can cause you to exit at precisely the wrong moment, just before the biggest profits materialize. Trap 5. Ignoring danger. Signals. Every major move gives signals when it's about to end. These aren't mystical signs. They're abnormal price movements that break the established pattern. During a healthy uptrend, reactions are natural, measured typically 4 to 6 points. Then suddenly, the stock drops 8 points in one day. That's abnormal. It's a danger signal. Think of it like a ship's captain. Small waves are normal, but when a massive wave appears out of pattern, it's warning of a coming storm. Most traders see danger signals but rationalize them away. Your stock has been climbing steadily for weeks, with normal reactions of 4 to 5 points. Then one day, it drops 9 points. You think, just a shakeout. It'll recover. Or you convince yourself, it's still above my entry price, so I'm fine. This is the human weakness Livermore warned about. When something happens abnormally stock market-wise, it is flashing you a danger signal which must not be ignored. The amateur's inner voice says, hold on, have faith. The professional's training says, something changed, get out now. The amateur hesitates. That hesitation costs him weeks or months of profits. The professional responds immediately to danger signals. Livermore compared it to walking along railroad tracks. If I saw an express train coming at me 60 miles an hour, I would not be damned fool enough not to get off the track and let the train go by. After it had passed, I could always get back on the track again, if I desired. When an abnormal movement occurs after weeks of normal action, he sells first and asks questions later. Maybe it's a false alarm. Maybe the move continues higher. Doesn't matter. He had a great profit, he protected it, and if the move resumes, he can always re-enter. But the danger signal is never ignored. During the bull market of the late 1920s, Livermore held large positions across multiple stocks. For months, every reaction was normal, 6 to 8 points, followed by a resumption of the trend. Then one day, after a stock made a new high, it suddenly dropped 10 points in the final hour. The next morning, it dropped another 2 points before rallying. To most traders, this looked like a temporary setback. But Livermore saw the abnormal pattern, the violent intraday reversal that had never occurred before. He sold immediately. Within days, the broader market rolled over into a significant decline. That one abnormal movement saved him millions. The signal was subtle but clear. He had trained himself to recognize it, and more importantly, to act on it without hesitation or second-guessing. Recognizing danger signals requires discipline. But Trap 6, the next psychological landmine, destroys discipline faster than any other force: the need to be right. Trap 6. Refusing to admit your wrong pride and ego create this trap. You made a trade based on your analysis. The market immediately moves against you, but admitting you're wrong feels like failure. So you hold, you rationalize, you find reasons why the market is wrong and you're right. It's psychological warfare. Livermore learned, we all know when we are wrong. The market will tell the speculator when he is wrong, because he is losing money. When he first realizes he is wrong is the time to clear out. The amateur treats being wrong as a personal attack on his intelligence. He bought because he did research. He had good reasons. Therefore, if the trade fails immediately, it's not that he was wrong, it's that the market hasn't recognized the truth yet. He holds. The small loss becomes a medium loss. Still he holds. It has to come back, he tells himself. The medium loss becomes a large loss. At this point, he's trapped psychologically. He can't sell now. That would mean admitting he was wrong from the start and sat through the entire decline. So he holds until forced out by margin call or capitulation. Livermore witnessed this pattern destroy trader after trader. The professional separates his ego from his positions. When he enters a trade and it immediately moves against him, he doesn't ask, who's right, me or the market? There's only one correct answer. The market is always right. He takes the small loss without hesitation. Livermore developed a firm rule: never permit a loss to run. His reasoning was simple. The speculator has to be his own insurance broker. The only way he can continue in business is to guard his capital account and never permit himself to lose enough to jeopardize his operations at some future date when his judgment is correct. Small losses are tuition. Losses are suicide. Livermore's cotton experience illustrates this principle perfectly. As mentioned earlier, he lost $30,000 on his first cotton position. His ego could have said, I did all this analysis. I know I'm right. I'm holding until I'm proven right. Instead, he admitted being wrong about the timing, closed the position, and preserved capital. He repeated this 5 times, each time taking a controlled loss when the market proved him premature. Yes, he lost $200,000 total. But when cotton finally made its move, he wasn't trapped in an underwater position. He had full capital available and made back multiples of those losses. His willingness to be wrong 5 times in a row allowed him to be spectacularly right on the 6th. That's the professional mindset. Wrong early, wrong often, but never catastrophically wrong. Being wrong about timing is forgivable. But Trap 7, the desperate attempt to recover losses quickly, compounds damage beyond repair. Trap 7. Trying to get even quickly after a loss after taking a loss. Emotional pressure builds. I need to make that money back now. This urgency creates reckless decisions. You start looking for quick trades, higher risk setups, anything to recover fast. It's like a soldier who just lost a battle and immediately charges the enemy without reconnaissance or strategy. Livermore observed, the urge to enrich themselves in too short a time causes traders to try to do it in 2 or 3 months instead of 2 or 3 years. The amateur takes a $5,000 loss on Monday. By Tuesday, he's hunting for a trade that can make back that $5,000 by Friday. His judgment is clouded by emotion. His risk tolerance expands. He takes positions larger than normal. He chases momentum stocks that have already moved. He acts on tips he'd normally ignore. Why? Because he's not trading the market anymore. He's trading his emotions. He needs to feel whole again. This desperate energy leads to more losses. The 5,000 becomes 8,000, then 12,000. Livermore called this unhealthy money the profits, or recovery achieved through reckless speculation that never stays in your account because it was earned without discipline. The professional responds completely differently. After a loss, he stops trading. Sometimes for days, sometimes for weeks. He reviews what went wrong. He checks his records. He waits for the market to present a proper setup according to his methodology. He doesn't care about making back the specific dollars he lost. He cares about finding the next high probability trade. Livermore's rule: successful businessmen don't expect to make over 25% on their investment in the first year. Yet speculators want 100% immediately. The professional treats speculation as a business. Losses are overhead. The goal isn't quick recovery, it's long-term survival and compound growth through disciplined, patient execution. After Livermore's $200,000 loss in cotton through impatient trading, he could have immediately jumped into another commodity to get even. Instead, he did something radical. He had the cotton ticker removed from his office. He needed to break the emotional attachment. For days, he didn't think about cotton. When the market finally gave a proper signal, he had missed the initial move. The market had rallied 500 points. That missed opportunity would have tormented most traders. But Livermore felt zero regret. Why? Because he knew those early losses happened precisely because he traded emotionally and prematurely. By removing himself completely, he broke the cycle. His account was preserved. His mind was clear. And when the next proper setup appeared in a different market, he was ready to execute flawlessly. That's professional discipline. Recovering from losses requires patience, but Trap 8 makes patience almost impossible. The seductive belief that someone else knows better than you. Trap 8. Following tips and inside information. This might be the most seductive trap of all. Your friend's uncle works at the company. Your broker heard something. Someone on social media posts impressive returns. The temptation to follow inside information is overwhelming. But Livermore warned, tips are the speculator's greatest enemy. Why? Because even if the information is accurate, you don't know when to act or when to exit. You're dependent on someone else's knowledge without understanding the complete picture. It's like joining a battle without knowing the strategy or terrain. Here's the classic scenario. At a dinner party, you meet someone who works at Great Shakes Corporation. Over drinks, he mentions business is fantastic. Earnings will be excellent. The stock is attractive. You're enthused. You buy shares the next Monday. For months, everything he said proves true. Earnings beat estimates. Dividends increase. The stock climbs. You're thrilled. Then suddenly, the stock collapses. You call your friend in a panic. Oh yes, he says calmly. Business has slowed down somewhat. The bears are attacking the stock. What he doesn't tell you, he and his colleagues started selling weeks ago when they saw internal numbers weakening. He can tell you when to buy. He'll never tell you when to sell. That would be betraying his company and colleagues. The professional makes this rule absolute. No tips, no inside information, no reliance on others' opinions. Livermore's method was pure. He kept his own records, did his own analysis, made his own decisions. When someone offered information, he thanked them politely and ignored it. His edge came from reading the market itself through price and time. He knew that if the information was truly valuable, it would show up in price action before the public knew. And if it didn't show in price action, either the information was wrong or not as significant as claimed. The market's message was the only insider information he needed. Everything else was noise and distraction. Livermore wrote in his book about the dinner party trap. Over a long period of years, I have rarely attended a dinner party including strangers that someone did not sit down beside me and inquire, "How can I make some money in the market?" His response evolved from lengthy explanations to a simple, "I don't know." Why? Because people wanted magic answers, quick tips, easy money. They didn't want to hear about studying price records, waiting for pivotal points, exercising patience. One woman pestered him relentlessly at a dinner party. Finally, he mentioned Cerro de Pasco, which had crossed a pivotal point. The stock advanced 15 points within a week. When his wife called the woman to tell her to sell, they learned she never bought it. She wanted to see whether the information was correct first. This perfectly captures why tips don't work, even when accurate. People don't have the conviction or understanding to act properly. Trading your own system builds conviction. But Trap 9 destroys that conviction by creating an illusion of safety that's actually your greatest vulnerability. Trap 9. Letting speculation become investment. This trap has an innocent beginning. You buy a stock to speculate. It goes against you, but you paid cash, no margin. So you think, I'll just hold it as an investment. Eventually it'll come back. This rationalization converts a speculative loss into a permanent one. Livermore stated, one should never permit speculative, Ventures to run into investments. The moment you change your thesis from "this will move" quickly to "I'll wait." Years, you've fallen into the trap. The amateur's thinking goes like this: I don't have to worry about fluctuations or margin calls. I never speculate. When I buy stocks, I buy them for investment. And if they go down, eventually they will come back. This sounds prudent. It's actually catastrophic. Livermore gave examples. New York, New Haven, and Hartford Railroad was considered safer than a bank deposit. In 1902, it sold at $255 per share. By 1940, it was 50 cents. Chicago Northwestern, $240. In 1906, 31 cents by 1940. Great Northern Railway, $348, down to $26. These were the safest investments of their era. Conditions changed. The investments evaporated. The professional makes a clear distinction. Every position is either a speculation or an investment from the start. If it's a speculation, it has a stop loss and a time limit. If it's an investment, it's based on long-term fundamentals and dividends, not price appreciation hopes. He never converts between categories. If a speculation goes wrong, he closes it with a loss. He doesn't suddenly pretend it's a long-term hold. Livermore observed that so-called investors actually lost more money than speculators because speculators used stops and exited bad positions, while investors held and hoped through complete collapses. The professional knows hope is not a strategy. Livermore pointed out the irony. Speculators are viewed as reckless gamblers, while investors are considered prudent. Yet the actual results proved opposite. The speculator who bought at 50, set a stop at 47, and got stopped out lost 3 points. The investor who bought at 50 and held for the long term rode the stock to 20, then 10, then 5, hoping it would come back. Who lost more? The investor lost 90%. The speculator lost 6%. Livermore concluded, the money lost by speculation alone is small compared with the gigantic sums lost by so-called investors who have let their investments ride. The professional understands this truth. He guards against losses aggressively. The amateur thinks he's being conservative by holding. He's actually being catastrophically reckless. Holding losses assumes prices will recover. But Trap 10 creates a different problem. Selling winners too early while holding losers too long. Trap 10. Believing you can trade profitably every day or week most. Traders think consistent action equals consistent profits. They trade daily, weekly, always active. But Livermore discovered there are times when one should speculate. And just as surely there are times when one should not speculate. The market only offers truly favorable conditions a few times per year. Think of a sniper. He doesn't fire constantly. He waits for the perfect shot. Then he takes it. The amateur keeps a running tab. Monday bought, Wednesday sold, Friday bought again. He feels productive. He's working hard at trading. But here's the reality. Most days offer no genuine opportunity. By forcing trades, he's essentially paying commissions and taking risks during periods when no clear trend exists. Livermore warned, you can beat a horse race, but you can't beat the races. Meaning, you might win individual trades, but trying to win every day guarantees long-term failure. The constant trader is laying the foundation for the patient trader's next winning position. The professional does nothing most of the time. He studies, he watches, he waits for the market to reach a pivotal point. When it arrives, he acts with full conviction and size. Then he sits back. Livermore said there are only a few times a year, possibly 4 or 5, when you should allow yourself to make any commitment at all. Between these moments, he's not idle. He's preparing, recording prices, identifying the next setup. But he's not trading. Patience isn't passive. It's strategic. Remember the mountain speculator Livermore wrote about? This man lived in the California mountains, received 3-day-old stock quotes, and came down 2 or 3 times per year to place orders. He made fortunes consistently. When asked how he could succeed with delayed information, he replied, real movements do not end the day they start. It takes time to complete a genuine movement. By being up in the mountains, I'm in a position to give these movements all the time they need. This man understood what the daily traders missed. Major moves unfold over weeks or months. Miss the noise, catch the symphony. Livermore adopted this philosophy and made his greatest profits by trading only at pivotal moments. Patience helps you wait for the right moment. But Trap 11 causes traders to act at exactly the wrong moment. Trap 11. Buying stocks because they've declined from their high, say, stock trades at $100, then drops to $50. The amateur thinks, it's cheap now. It was worth $100 before, so at $50 it's a bargain. This is backwards thinking. Livermore's rule: never buy a stock because it has had a big decline from its previous high. Why? Because there's always a good reason for the decline. The stock may still be overpriced at 50. It might drop to 20. Price history doesn't predict price future. The amateur sees a chart. This stock was $100 last year. Now it's 50. If I buy here and it just gets back to 80, I'll make 60%. Sounds logical, but he's ignoring why it fell. Maybe earnings collapsed. Maybe the industry is dying. Maybe competitors are crushing them. He's buying based on where it was, not where it's going. Livermore learned this through painful experience. The likelihood is that the decline is based on a very good reason. That stock may still be selling at an extremely high price. Even if the current level seems low, the professional ignores price history. He doesn't care that a stock was once $100. He asks, is this stock in an upward trend now? Has it crossed a pivotal point that signals strength? If not, he doesn't touch it, regardless of how cheap it looks. Livermore made his money by buying stocks making new highs, not new lows. He bought strength, not weakness. When a stock is strong enough to break through resistance and make new highs, that's when he entered. The previous high price was irrelevant. Only current momentum mattered. Livermore gave a stark example. Suppose a stock is trading at $25, having held between 22 and 28 for a year. Most traders would buy at 25, thinking it's cheap in that range. Livermore waited for it to break 30, a new high. Only then did he buy. Why? Because breaking 30 proved the stock had accumulated enough strength to start a real move. His rule: when I see by my records that an upward trend is in progress, I become a buyer as soon as a stock makes a new high on its movement. Buy strength, not perceived bargains. Buying weakness is a trap. But trap 12 is its mirror image, selling strength too early because something seems high. Trap 12, selling stocks because they seem too high. This trap ruins more potential fortunes than perhaps any other. You watch a stock go from $10 to $50. Your mind screams it's too high. It's going to crash. So you short it or avoid it entirely. Meanwhile, it climbs to $150. Livermore's warning: never sell a stock because it seems high-priced. A stock at 50 could be at the beginning of a move to 150. Price level alone tells you nothing about direction. The amateur thinks in absolute terms. $50 is expensive for this stock. It was only $10 last year. He shorts it at 50. The stock climbs to 70. He adds to his short position, convinced it must come down. It reaches 90. He's now deeply underwater. This thinking destroyed countless traders in every bull market in history. They shorted V too early, convinced stocks were too high, and watched in agony as the market continued higher for months or years. Livermore observed, many have lost their capital funds by selling a stock short after a long upward movement when it seemed too high. The professional never judges price by absolute levels. A stock at 50 can go to 150 if the trend is strong and fundamentals support it. Livermore's approach: he bought stocks making new highs, not because they were high, but because breaking into new territory proved strength. He only considered selling when the stock gave a danger signal, an abnormal movement that broke the pattern. Price level was irrelevant. Only the pattern mattered. If the upward trend remained intact, he held regardless of how expensive others thought it was. In Livermore's anaconda trades, he bought at 100, watched it climb to 150. Did he sell because it seemed high? No, he bought more when it reached 200, again at 300. Each time amateurs said, too high. Each time the stock proved them wrong by continuing higher. Only when it failed to continue past 300, hitting 302 and 3/8 instead of powering through, did Livermore sell. The signal wasn't high price. The signal was failure to continue the pattern. He sold his entire position within minutes, getting filled between 300 and 298. Days later, Anaconda was at 225. The professionals who bought at 100 and held to 300 won. The amateurs who shorted at 150 because it seemed high were destroyed. Let's bring this complete system together. These 12 psychological traps are not separate issues. They're connected failure points in the mental discipline required for successful speculation. Jesse Livermore's genius wasn't just identifying them, it was showing how they all stem from the same root cause, letting emotion override method. The system works like this. It begins with capital preservation, never averaging losses, cutting positions when wrong, protecting your trading capital as an insurance broker would. It moves to emotional discipline, taking profits when the market signals, not when fear strikes, holding positions when they're working, not exiting prematurely. It demands patience, trading only when pivotal points are reached, doing nothing between those rare moments, waiting for market confirmation instead of acting on opinions. It requires independence, ignoring tips, making your own decisions based on price action, refusing to convert speculation into hope. And it necessitates trend recognition, buying strength, not weakness, selling when danger signals appear, not when prices seem high, letting the market tell you when you're right instead of forcing your beliefs onto the market. This is not pattern recognition. This is mental discipline. It's a complete psychological framework for approaching speculation. Here's what this really means. The 90% who fail exhibit these patterns. They average down losses, hoping to recover. They take quick profits while holding losses long. They trade constantly, needing action. They act on opinions before confirmation. They ignore danger signals. They refuse to admit being wrong. They chase losses desperately. They follow tips. They convert speculations into investments when wrong. They buy dips and sell rallies. They judge stocks as cheap or expensive based on past prices. The 10% who succeed do the opposite. They cut losses ruthlessly and let profits run. They trade rarely but decisively. They wait for market confirmation. They act on signals immediately. They admit when wrong without hesitation. They recover losses slowly through discipline. They trust only their own analysis. They maintain clear position definitions. They buy strength and sell weakness. They judge stocks only by current trend and momentum. Now, let me be clear, this is not easy. Livermore himself said, "The game of speculation is not a game for the stupid, the mentally lazy, the man of inferior emotional balance, nor for the get-rich-quick adventurer. They will die poor." So here's my challenge to you. Pick one of these 12 traps, the one you recognize in yourself most clearly, and commit to eliminating it over the next 30 days. Don't try to fix all 12 at once. That's another form of overtrading. Focus on one, master it, then move to the next. Jesse Livermore spent 40 years learning these lessons, losing fortunes, and rebuilding them. The question is, will you apply them? If this changed how you think about trading psychology, hit that like button. Subscribe for more deep dives into legendary trading strategies. And drop a comment. Which of these 12 traps has cost you the most money? Be honest. I read every comment, and I'll respond with specific advice for breaking that pattern.